Hey everyone, and welcome. Today, we're diving into a really fascinating technical indicator, one that's totally different from the usual suspects. It wasn't cooked up in some complex algorithm, but was actually born out of a deeply human question about loss and eventually recovery. All right, so first up, let's talk about the exact problem this thing was built to solve. It's a huge challenge, something every single long-term investor is going to run into at some point.
Yeah, it really boils down to this one question, doesn't it? After a massive market drop, when your gut is screaming sell and every headline is predicting doom, how do you find the nerve to even think about buying again? I mean, trying to time the absolute bottom, it feels impossible. You go in too early, you get burned. You wait too long, you miss the recovery. It's tough.
So how do you tackle a problem that's so human? Well, it turns out the solution is surprisingly human too. And the answer didn't come from some Wall Street math genius, but from an economist who looked in a very, very unexpected place. All right, so let me introduce you to the man himself, Edwin Coppock. We're going back to the 1960s here, and Coppock was on a mission. He wanted to build a truly reliable signal for long-term investors, something that could tell them when the worst was likely over and it was a good time to get back into the market. Okay, and this is where the story gets really, really interesting. His big idea came from a place you'd never expect. He didn't go to a mathematician. Nope. He went and asked leaders at the Episcopal Church a simple question. How long does it typically take for a person to grieve the loss of a loved one? And they told him, on average, about 11 to 14 months. That was his light bulb moment. He theorized that a market crash is a form of collective grief for investors, and that the recovery might follow a similar emotional timeline. And just like that, from this super unique idea, the Coppock Curve was born. At its core, it's a long-term momentum indicator, but what it's really trying to do is measure that collective investor grieving process. Its whole job is to filter out all that chaotic, day-to-day market noise to pinpoint the moment when that emotional bottom is hit and a real sustainable recovery can begin. Okay, so you're probably wondering how on earth you turn grief into a line on a chart. Let's get into the nitty-gritty of how this thing actually works, and more importantly, what we're supposed to be looking for when we see it. So the math here is tied directly to that 11 to 14-month grieving period we talked about. First, it looks at something called the rate of change, which is just a fancy way of saying how fast the market is moving over both an 11-month and a 14-month window. Then it adds those two values together. And that last step, you can think of it like sanding a rough piece of wood. It just smooths out all the splinters, the short-term market jumps and dips, to show you the real underlying trend. All right, so when you're looking at this thing on a chart, the zero line is everything. It's the magic number. As long as the curve is below zero, that means the market is still in that grieving phase. There's a lot of downward pressure. But the big moment, the signal you're waiting for, is when that curve hits a bottom, starts to hook back up, and punches above that zero line. That is your primary buy signal. It's the indicator's way of saying, okay, the emotional selling is likely over and a new bull phase might be starting. All right, theory is one thing, but how does this thing actually hold up in the real world? Let's take a look at the track record during some major historical crises and see if this idea of market grief actually works. So, does it actually work? Well, when you look back, the results are pretty darn compelling. Think about it. After the dot-com bubble imploded, the curve called the bottom in late 2002. Then, in the absolute darkest days of the 2008 financial crisis, it turned positive in early 2009, right as the new bull market was kicking off. And more recently, after that crazy COVID crash in 2020, it plunged and then shot right back up, perfectly capturing that super fast V-shaped recovery. Okay, but here's a really important reality check. As cool as this indicator is, it is not a crystal ball. You have to use it responsibly, and that means understanding its strengths and, just as critically, its weaknesses. So let's get real and just lay out the pros and cons. On the upside, it's pretty simple to read. It's fantastic for spotting those huge market bottoms, which is exactly what a long-term investor wants to see. And it does a great job cutting through all that market noise. But, and this is a big but, it's a lagging indicator. What that means is it confirms a bottom after it's already started to happen, so you're not going to catch the absolute to the penny low. It's also not built to give you sell signals, and it can kind of get confused and give false signals if the market is just chopping sideways. And this brings us to what might be the most important takeaway of all. You should never use the Coppock curve all by itself. Don't use it in a vacuum. Instead,
Think of it like a key witness in a courtroom. It's powerful, but you want other witnesses, other indicators to back up its story. A smart trader might wait for the Coppock curve to cross above zero and for the MACD to show a bullish crossover. When you get multiple tools all pointing in the same direction, that's when you have a really strong case for making a move.
And that really brings us full circle. The Coppock curve is so much more than just a line on a chart. It's this beautiful reminder that markets are, at their heart, driven by human emotions. So here's a final thought to leave you with. By thinking about a bear market not just as numbers on a screen, but as a kind of collective grieving process, could that help us become more patient, more disciplined, and maybe, just maybe, better investors in the long run? That's the powerful idea at the heart of the Coppock curve.